Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 4th of October. My name is Fook Hien and I'm your host for the podcast. We're seeing some risk-off sentiment again in the markets, with equities and bonds both falling. The US 10-year government bond yields continue to make new multi-year highs, and the US dollar also making year-to-date highs. The VIX index, which measures the volatility of the S&P 500 and sometimes called the fear index, has also hit 20, a level it hasn't reached since May. So the macro environment is rather uncertain. Now, when we get big moves in asset prices, there is an additional fear of whether someone out there is making big losses, and if this someone is a big market participant, this could have a big impact on the market or the economy. Back in March this year, a risk-off event that happened was the collapse of several small to mid-sized US banks. Now, with such situations, it is never one factor, but a combination of different factors that acted to cause the collapse, and it can be very complicated to analyze the cause. But one of the factors related to unrealized losses in the bond portfolio held by banks. With the yield rising rapidly in the last 2 years, some banks were sitting on large unrealized losses in their bond holdings just based on the market price for bonds. Now, as the US 10-year yields have risen further to a 16-year high, the issue of unrealized losses will likely be back on the radar. In the upcoming Q3 earnings season, banks will likely be asked about their bond portfolio. So such uncertainty and unknowns are one reason why we advocate having gold as a core holding in your investment portfolio. Gold acts as a portfolio hedge. In the month of March, when the regional banking index fell by nearly 30%, gold was up nearly 9%. I'm definitely not suggesting we have a financial crisis, but the point I'm highlighting is that gold does well in times of crisis. But why is gold not working at the moment and registering losses since September? Well, in our global market outlook, there is a one-line summary that very neatly explains it. Next to gold, we have a positive sign that it acts as a portfolio hedge. And next to that, a negative sign with risk of a US dollar rebound and rising yields. And that is exactly what we have now. Strong dollar and rising yields, that is driving gold lower. But the RSI technical indicator is around 21 now, indicating it is oversold. And it is approaching a support level we see at 1805, a support that held at the end of February. So it looks like a good time now, if you don't have it, to look towards adding gold as a core holding and as a portfolio hedge. We have a 12-month forecast for gold at 2010. That's all from me today. As always, if you enjoyed the podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a great day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.